Hi guys, well in this video I'll be showing you where I get a 10% return on my stock investment. But before that, a brief history lesson. Back in the day when you wanted to invest in the stock exchange, you had to go through a stockbroker. A stockbroker would then place your money with a fund manager who would then try to pick the best stocks to get the maximum growth for your money. Well, it turns out of all these overpaid fund managers, 75% of them couldn't even replicate the market average. So Jack Bogle of Vanguard came up with an idea. He says, well, why don't we pick up a computer algorithm that replicates the market average, and because we don't have to pay a fund manager 1.5%, we can give that extra 1.5% back to the investor. And that's how in 1975 Vanguard launched the first index tracker. Okay, so what is an index? Well, an index is just a list of companies, a league table if you wish, of publicly traded companies, often listed by size, that is market cap, which is another bit of jargon. Market cap stands for market capitalization, and it's just the value of the company. And it's defined as the amount of shares multiplied by the cost of the share. So as an example, if you've got 100 shares and each share is worth £1, then your market capitalization is £100. And essentially what an index does is just list them, rather like the Premier League if you want, with the most expensive, most valuable, the highest market cap at the top, and they're all the way down to the bottom with the least market cap in it. Now, there are lots of indexes across the world. The one you're probably most familiar with is our own FTSE. FTSE stands for the Financial Times and Stock Exchange Group. So the FTSE lists all the publicly listed companies on the London Stock Exchange. They consist of the FTSE All Share, which is broken down again into the FTSE 100, which, as the name suggests, is the top 100 publicly traded companies on the London Stock Exchange. There's two other bits of jargon in my opening statement, and they were index trackers and ETFs. Now, don't get hung up on the difference. They're both essentially the same thing. The principal difference between them is an index tracker is priced at the end of the day up to a value of the funds it holds within it, and they decide how much you can buy that fund for, a piece of that fund, a share of that fund, the following day, and it will stay at that price all day. Whereas on an exchange traded fund, as the name suggests, it's traded throughout the day and its price will change depending upon the underlying stock that it's invested in. But essentially they are the same thing, and they both try to replicate the behavior of an index that they're following. Okay, so let me show you how an index tracker or an ETF tries to replicate the market. And I'm going to use the FTSE 100 as an example. So the FTSE 100, at the top market cap is a company called Unilever. Then there's Royal Dutch Shell. In fact, the Royal Dutch Shell is split into two different companies, and they lie currently second and third in terms of market cap. The next one is BHP, and then AstraZeneca, which has just become more famous due to its COVID vaccine, and HSBC. We'll just use the top 1 to 6 of them. Now, it tells you a little about the makeup of the FTSE 100 and how it's weighted, because Unilever provide products for sale on supermarket shelves and what have you. RDS, Royal Dutch Shell, petrochemicals, AstraZeneca of pharmaceuticals, HSBC, obviously Hong Kong, Shanghai Bank of Commerce, so it's banking. So the FTSE leans towards petrochemicals and service industry companies. And what the algorithm tries to do is split every pound that you invest in your fund in the following manner. Now, this is an example, they're all slightly different, but here's what they do. So let's say that of the total FTSE market capitalization, that Unilever represents about 7% of the marketplace, and the RDS, two RDSs make up 6%, and BHP is 5%, AstraZeneca 4%, and HSBC 3%. Now, I'm making these numbers up just for explanation, to give you an example. So what they would do is, for every pound you invest, the algorithm would put 7 pence into Unilever, 6 pence and 6 pence in the two RDS companies, 5 pence into them, and HSBC 3 pence, and so on, all the way down to the bottom, the 100 on the list there. And by doing so, it captures the average. Now, what it also does is it puts the majority of your money into the bigger companies, so they are not likely to fail. So your money's more secure that way. Right down at the bottom on the list, the one that's in the bottom 100, the reason that they have less money in there, but you'll get your capital growth in there. It's much easier to double the value of a company that's 100 on the list than it is to double the value of Unilever. So then the company who's organizing the fund will just do that and put it into a fund. So there'll be a big pie, and inside here will be all the companies split in the way I described that are in the FTSE 100, and they'll call this the FTSE 100 fund. So that's an example of an index, and when you buy shares in it, you're buying a little slice of the fund. In truth, you're not buying a piece of BHP or RDS or AstraZeneca, you're buying a piece of the fund itself. Now, there are lots of different funds across the world. If you like the petrochemicals, easy for me to say, petrochemicals and the service sector, then you invest in the FTSE. If you like the FANG stocks, the tech stocks, you want to say FANG, you might want to invest in the S&P 500, and that's another index. It's an American index, and Standard & Poor is what it stands for, and this is the top 500 US publicly traded funds. And in this fund you will find the FANG funds. FANG stand for Facebook, Amazon, Netflix, and Google. So if you fancy the growth in that sector, then you're more likely to choose the S&P 500. Obviously, these aren't traded in here, so you don't get exposure to these FANG companies if you're choosing a FTSE 100 index. Now, I haven't looked, but I will bet there is a fund called the FTSE and S&P 500. So there are lots and lots of funds all across the world trading in Hong Kong or the German or a European fund or what have you. So lots of different funds, and it's up to you to choose which one you want to invest in. Now, I said earlier in the video that I would tell you what fund that I invest in, and I invest in the FTSE All World ETF. And I checked before I come on, it's grown by over 33% in less than 3 years, and that's over the COVID period as well. So what it invests in, if you go on the Vanguard site, it's vanguardinvestor.co.uk, they list all their funds, and you click on a fund and it'll tell you exactly where it's investing. And as it suggests, it's invested in the FTSE and All World, which is a growth market. So you're looking at the new emerging markets out in Asia and what have you. So I not only get the FTSE, which is the one I'm familiar with, of course, being British, but I also get exposure to the All World, giving me some great growth. And as I said, it's around 33% in less than 3 years. So it's over 10% a year, which isn't too shabby in anybody's book. Now, there are two traditional and very different methods of investing. One is you get a lump sum and you put it all in one go. And that's you trying to second guess the marketplace, beat the marketplace. So you're saying to yourself, I think the market's at a trough here. It's not going to go any lower, and I'm going to put my money in here. Now, it's very, very difficult to time the marketplace. Nobody seems to do it. So it's not the most efficient way to do it. The most efficient way to do it is to make regular contributions. Now, if I draw the growth in the marketplace as being a steady growth, a linear growth such as that, that would mean that every time you bought, let's say a monthly basis, I put £100 a month in because I use it as my emergency fund. And if I bought this month here, then I bought this month here, then I bought this month here, then I bought this month here, every time I bought my shares, they cost me more money because the price is going up every time. So I'm buying less shares, fewer shares for the same amount of money. It's far better and more efficient, and thankfully this is the way the market behaves, if it does this. And if you look at any chart of the stock exchange, that's what it happens. And these can be minute by minute changes, hour by hour, day by day, and occasionally we get a drop. COVID comes along, or we get a market crash such as in 2007, 2008. But a year later it recovered. And what the benefit of these, when the troughs, if you put in regular contributions, sometimes you will buy on a small peak, but occasionally you'll buy at a trough as well. And it's buying in the troughs that gets you the maximum growth, because you get this growth. If you bought on a peak, you only get this growth here. So by putting regular contributions in, you're more likely to hit those little troughs throughout the day. And it's something called pound cost averaging, or if you're buying in dollars, dollar cost averaging. And that is the most efficient way to buy in regular contributions. So there we go, guys. That's my introduction to index trackers and ETFs. I've explained where I invest. I use the FTSE All World ETF. I've gotten over 30% in the last 3 years. So I'm getting over 10% a year. If you want to know more and choose your own funds, you can all do it via your phone. Go to vanguardinvestor.co.uk, open up an account, look at all the index funds and make your decision. Good luck with your investing. Don't be stupid, don't be normal. Please, if you haven't subscribed already, do so. Give it a nice thumbs up, and any comments or questions, please add them below and I'll answer them as soon as I can. Bye, guys.